Dear students, today I'll discuss about a very important chapter, that is national income. Rather, this is not a chapter, actually 3 chapters are there in national income. The first one is about circular flow of income. By the way, the ISC students, as my video is for, my advices are for ISC students. One factors in the last year's ISC 2024, circular flow of income in a 4-sector model came as a question. So in this year, you may expect, if circular flow of income question comes, it can be 2-sector model or they can give 3-sector model. Now in the 2-sector model or 3-sector model, in the first one, 2-sector model, households and firms are on the 2 sides. Households purchase goods and services from the firms and in return they pay the prices of the goods and services. Again, firms purchase the factor services from the households and in return they pay the factor payments, wages, rent, interest and profits. In the middle, there is the capital market consisting of banks. The households deposit their savings into the banks, that is the capital market, and the banks accumulate those savings and out of that they give as loans to the industrialists or the firm owners. The firm owners or the industrialists, the businessmen, that is the firm owners, producers, they use that money that they get as loans from the banks for expansion of their productive capacity, for addition to the capital stock, and this process of getting the loans and using that for addition to the capital stock, for adding to the productive capacity, this is investment. So investment is a flow from capital market to the firms. The savings from the household to the capital market, that is called leakage, and from the capital market to the firms, the investment, that is the injection. Savings is a leakage because that is being extracted outside the circular flow of income. And injection because that money which was once accumulated by the banks is being again put into the circular flow of income. This is the 2-sector model. In the 3-sector model, we have the government in addition to the 2-sector model. In addition to the 2-sector model, one more sector is added, and that is government. The households pay taxes to the government. The firms also pay taxes to the government. Now the government gives unilateral transfers and factor payments to the households. Unilateral transfers like pension, scholarship, these are unilateral transfers, one-sided transfers from the government to the households. And factor payments, many households, they provide the labor services, they provide the capital, they provide the land to the government for making the production units or for the government services. That is why the government purchases the factor services from the households and in return the government pays or gives the factor payments. Now on the other side, the government gives subsidies and payments for government purchases to the firms. The government gives subsidies to some companies, some firms, and also the government gives or makes payment to the firms in return of the purchases that the government makes. Like government purchases huge quantity of various goods and services from the firms, and in return the government has to make the payments for those. So this is the 3-sector model. Now what is the equilibrium condition in the 2-sector model? What is the equilibrium condition? Saving is equal to investment. Now what is the equilibrium condition in the 3-sector model? The equilibrium condition in the 3-sector model is S plus T is equal to I plus G. Saving plus taxes is equal to investment plus government expenditure. Taxes constitute leakage. Taxes are leakage like savings. Whereas government expenditure is injection like the investment. So government expenditure and investment, these can be considered as leakages, injections. Saving and taxes can be considered as leakages. And equilibrium in the equilibrium condition in the four sector model. Though four sector model question came in the last year, but they can give a short question or an MCQ with regard to equilibrium condition in the four sector model, which is savings plus taxes plus imports, S plus T plus M, is equal to investment plus government expenditure plus exports. Imports, in addition to savings and taxes, imports are leakages because money goes out. And exports, in addition to investment and government expenditure, exports is injection. So leakages are savings, taxes and imports. Injections are investment, government expenditure and exports. So from the circular flow of income, this part, these can be the probable questions. Now coming to the next chapter, that is national income aggregates, different concepts. Here firstly, you need to know the definitions or the meanings of GDP, GNP, gross domestic product, gross national product, net domestic product, net national product, NNP, that is net national product, NDP, that is net domestic product. These four basic concepts. Then factor cost, the value at factor cost, the value at market price. So you need to know the definitions of these. Now they may give fill in the blanks also, like from GDPFC to GDPMP, from GNPFC to NNPFC, or national income, because national income is what? NNPFC, net national product at factor cost, that is national income. Now they can give fill in the blanks also. Now in order to do these conversions or the fill in the blanks, if you know three rules, then you can do any of these fill in the blanks. Now what those rules are? Firstly, gross to net. How to convert from gross to net? Gross minus depreciation is equal to net. Second, domestic to national. Domestic to national. Any domestic value to the national value. Now, domestic plus NFIN, net factor income from abroad, you get national. The third one is from factor cost value to the market price value. Factor cost to market price. How? Any value at factor cost plus net indirect taxes is equal to the value at market price. So these three are the rules which you may remember to solve all those fill in the blanks type of questions. Now, apart from these, then you have private income. That is the total of factor incomes, including retained profits of the organizations or corporations from all sources and current transfers from the government and rest of the world to the private sector. That is private sector's income, entire income of the private sector. Now, how to get private income from national income? You have to remember the equation. That is national income minus income from properties and entrepreneurship accruing to the government, commercial enterprises and administrative departments, minus savings of non-departmental enterprises of the government. These two will be deducted, subtracted. National income minus income from property and entrepreneurship accruing to the government, commercial enterprises and administrative departments. And then again minus savings of non-departmental enterprises of the government. Now these two are subtracted, and what will be added in order to get the private income from national income? Plus, you will be adding interest on national debt, which the people get, the private sector, that is private individuals get, plus net current transfers from the government. Net current transfers from the government plus net current transfers, current transfers from abroad. So you need to remember this equation, how to get private income from national income. Next is personal income. What is personal income? That is the total income earning actually received by people from all sources in the form of factor payments, incomes and current transfers payments during a year. People, persons. Here the factor is about persons, not the private sector but private individuals. So personal income is equal to private income minus undistributed profits, minus corporate profits taxes, minus retained earnings of foreign companies. That means the entire earning of the corporate sector, private enterprises. That is why we are subtracting undistributed profits which are retained by the enterprises, organizations, companies. Corporate profits taxes which are paid by the taxes which are paid by the private sector companies, corporate sector companies to the government. And also we are subtracting the retained earnings of the foreign companies also. So this is how we get personal income. Next is personal disposable income. Personal disposable income refers to that income of the persons. It is that part of the personal income which is available for the individuals to be used in the ways they like. They can spend that money for consumption. They can spend that money. They can also save that money. So it is the income available to the households or the persons which they can spend on consumption or they may save. So how to get personal disposable income from personal income? Here also you have to remember an equation. Personal disposable income or disposable personal income, DPI, disposable personal income, is equal to personal income minus personal taxes minus miscellaneous receipts of the government administrative departments. Personal taxes like income taxes, direct taxes, property taxes, minus miscellaneous, that means various types of receipts of the government administrative departments, like the fees and fines and other sorts of receipts of the government administrative departments from the people. Now, in another way, we can say personal disposable income is equal to consumption expenditure of the households plus the household savings. That means the money that the persons can use for consumption purpose and also for savings. Thus, personal disposable income is equal to consumption expenditure of households plus household savings. So this is all about private income, personal disposable income, these. Now, if you are given a question regarding nominal GDP and real GDP, this can be given a question like distinguish between nominal GDP and real GDP. By the way, nominal GDP is also called GDP at current prices and real GDP is also called GDP at constant prices. Nominal GDP or GDP at current prices is the money value of all final goods and services produced in a country, within the country, during a particular time period, like a year, during a particular year, expressed at the market prices prevailing in that year, not adjusted for inflation. Here we are not considering any sort of inflation factor here. Whereas real GDP or GDP at constant prices is adjusted for inflation. It measures the value, money value of all final goods and services which are produced within the country in a year. And here the GDP, the measurement is done, the value is measured at the market prices prevailing not in the current year but in a particular year in the past, which is considered as the base year. Now there's a formula here. GDP at constant prices is equal to GDP at current prices divided by the price index number of the current year into 100. GDP at constant prices is equal to GDP at current prices divided by price index number of the current year into 100. So this is how we get uh, you can remember all these different concepts, like right from starting from GDP, GNP, NDP, NNP, factor cost, market price. Then from national income you can get private income, then private income to personal income to personal disposable income, and at last you have to remember that GDP at constant prices, GDP at current prices, these. Okay. Now after that you have the next chapter, which is so important, because in this chapter you have the methods of measuring national income. Now before that, I would like to discuss some other concepts also, like national disposable income. What is national disposable income? National disposable income is the sum total of national income of the whole country at market prices and net current transfers received from rest of the world. National income, the sum total of the entire nation's income at market prices and also net current transfers received from rest of the world. Now what is disposable income? Total disposable income is national income plus net current transfers. Next is net national disposable income. Before going into net national disposable income, you need to know gross national disposable income. GNDI, gross national disposable income. Gross national disposable income is equal to GNP/MP, gross national product at market price, plus net current transfers received from rest of the world. Net current transfers from rest of the world. Then, in that sense, in a similar way, net national disposable income, NNDI, net national disposable income is NNP/MP, net national product at market price, plus net current transfers from rest of the world. NNP/MP plus net current transfers from rest of the world. Now suppose in the question is given net current transfers to rest of the world. Then instead of adding, you have to subtract. Sorry. In order to get the NNDI, net national disposable income, NNP/MP, minus net current transfers to abroad, to rest of the world. But if it's given net current transfers from rest of the world, then you have to add. So net national disposable income is equal to NNP/MP plus net current transfers from rest of the world. Whereas if it's given net current transfers to abroad, then you have to subtract. Now I come to the next chapter, the last one, the third one, which is very, very important, because very sure that numerical sum will come from this chapter. Methods of measuring national income. There are three methods: expenditure method, income method, and value added method. First, expenditure method. You need to remember the steps. If you remember the steps very well, any sum given to you, you can do it. First, the steps. Let me tell you the steps. The first step, private final consumption expenditure plus gross domestic capital formation plus government expenditure, government final consumption expenditure plus net exports, that means exports minus imports. By adding these, private final consumption expenditure, gross domestic capital formation, government final consumption expenditure, and net exports. By adding these, we get GDP/MP, gross domestic product at market price. First step. Next step, GDP/MP minus depreciation. If in the question is given consumption of fixed capital, this term is used, this is given as an entry, then that is nothing but depreciation. Depreciation is also called consumption of fixed capital. So GDP/MP minus depreciation or minus consumption of fixed capital, you will get gross minus depreciation is equal to NDP/MP. So this is second step. Third step, next step. NDPMP plus NFIA, net factor income for abroad, is equal to NNPMP, net national product at market price. Last step, NNPMP minus net indirect taxes is equal to NNPFC, or national income. NNPMP minus net indirect taxes. Now, net indirect taxes, it can be given in the question separately, indirect taxes and subsidies. Then indirect taxes minus subsidies, that is net indirect taxes. So the last step is NNPMP minus net indirect taxes, that is indirect taxes minus subsidies, is equal to NNPFC, that is national income. Now, there can be some modification in the question, like instead of giving gross domestic capital formation, they may give in the question net domestic capital formation, or maybe both are given, gross domestic capital formation, net domestic capital formation, both are given. Now, if both are given, why should you take gross domestic capital formation? Directly you take net domestic capital formation. Then, right in the first step, private final consumption expenditure plus net domestic capital formation plus government final consumption expenditure plus net exports is equal to NDPMP. Right in the first step, NDPMP. Then the next two steps will be same. NDPMP plus NFIA, NNPMP. NNPMP minus net indirect taxes is equal to NNPFC, or national income. Fine, this can be one modification. Another modification is change in stock can be given. As an entry in the question for the numerical sum, change in stock can be given. Then that gross domestic capital formation plus change in stock, we get gross domestic fixed capital formation plus change in stock. Actually, then we get gross domestic capital formation. If you don't do in that manner, only you write as a step private final consumption expenditure plus gross domestic fixed capital formation plus government final consumption expenditure plus net exports plus change in stock. You will get the same thing, GDPMP. And then the following steps will be, the next steps will be following as it is, that is GDPMP minus depreciation or consumption of fixed capital is equal to NDPMP. NDPMP plus NFIA is equal to NNPMP. NNPMP minus net indirect taxes is equal to NNPFC, or national income. So this is all about the first method, expenditure method. Now we come to income method. In the income method, what are basic steps here? Compensation of employees plus operating surplus plus mixed income of self-employed. These three added, we get NDPFC. NDPFC, net domestic product at factor cost. What is that? Domestic factor income. NDPFC, or domestic factor income, is equal to compensation of employees plus operating surplus plus mixed income of self-employed, these three. Now I'll go into a little details of compensation of employees. There can be a question, what are the components of compensation of employees? Employees are workers who work under somebody else. Then the compensation against their work, compensation against their work done, that is compensation of employees to the employees given by the employers. Then what are the components here? Firstly, basic salaries and wages. Basic salaries and wages. Second component is supplementary labor income. Supplementary labor income like bonus, DNS allowance, house rent allowance, then employers' contribution to social security scheme. And the third component is payments in kind, like free or subsidized food, free medical facilities, these. So these are the components of compensation of employees. If the question comes, what are the components of compensation of employees? You have to write like this. You have to categorize these, the subcategories you have to write, and under them what falls, what are the components of components also you have to write. Now I come to operating surplus. What is operating surplus? Operating surplus is defined as the sum total of income earning from capital assets, properties, and entrepreneurship. Capital, assets, properties, and entrepreneurship. Then, what are the components here? Operating surplus is equal to rent plus interest plus profits. If in the question royalty is given, then you have to take royalty also. Now, rent, interest, it's given, okay. If it's given in the question, you have to take it, surely. Now, in case of profits, there can be a little twist in the question. Instead of giving directly profits, they may give three subcomponents of profits actually. Now, what is here? The private companies, the private enterprises, when they receive the profits, when they get the profits, from that, they first give the corporation taxes to the government. Then they give the dividends. They give the dividends to the shareholders. And then the rest part of the profits, which is retained by the company, which is undistributed profits. So in the question, instead of giving directly profits, they may give these three separately. Corporation tax, dividends, and undistributed profits. So you have to add these three: corporation taxes plus dividends plus undistributed profits. You will get the profits. Anyway, so these are the components of operating surplus. And mixed income self-employed, you know, self-employed are the people who do their own business by themselves. They do not even take any other factors like laborers are not recruited or employed. And the income that they earn is a mixed bag of income. The person does his business, manages his business, operates his business all by himself. Everything he does, he or she does. Wages, rent, interest, profits, everything he gets. So it is termed as mixed income of self-employed. Thus, this is the first step in income method. Compensation of employees plus operating surplus plus mixed income self-employed is equal to NDPFC or domestic factory income, net domestic product at factor cost, or domestic factory income, NDPFC. One more step, NDPFC plus NFIA, net factory income from abroad. What do you get? NNPFC or national income. So this is all about income method. Now I come to the third or the last method, which is value added method. Value added method. What is value added? Value of the final output minus value of intermediate goods used. Value of final output minus value of intermediate goods used. Then what are the steps involved here in the calculation of national income? Firstly, total value of final output in primary sector, secondary sector, and tertiary sector. That means in the whole economy. Minus total value of intermediate goods consumed, or you can say total value of intermediate consumption in primary sector, secondary sector, and tertiary sector. That means in the whole economy. So total value of final output in the entire economy, primary, secondary, and tertiary sectors, minus total value of intermediate consumption, intermediate goods consumed in primary, secondary, and tertiary sectors. That means the whole economy. By doing this, by subtracting this, we get gross value added at market price. Gross value added at market price, or we can say GDP-MP. First step. The next step, or you can now, after this first step, you can write all together. GDP-MP or gross value added at market price minus depreciation, that is NDP-MP we get, plus NFIA we get an NPMP, minus net indirect taxes, then at last we get an NPFC or national income. So this is about the value added method. Now I come to see, based on these three methods, it's sure that they will give numerical sum. Now one sum may come where you are required to find out maybe GDP-MP or GNP-MP or GNPFC or national income by using income method and expenditure method. Or they may give a sum where you need to find out the national income by using the value-added method. By the way, value-added method has several other names. Like value-added method is also called product method, or production method, or net output method. The same method is known different names by different names. Now, after this, I think you can do successfully, correctly, all numerical sums if you follow these steps. Please do remember all these steps very well. Now, after these numerical sums things in this chapter, you have one more very important topic, very, very important, that is precautions and difficulties. Precautions and difficulties, though it's theoretical, but here it's not absolutely theoretical to mug up, to learn by heart. You need to understand these precautions and difficulties. Like all final products should be included irrespective of whether expenditure is incurred or not. Goods which are meant for self-consumption or imputed value of owner-occupied houses, value of own account production of machinery and equipment should be added. That means goods meant for self-consumption, like by farmers, then imputed value of the self-occupied houses should be taken into account. Value of own account production of machinery and equipment should be added, should be included in national income. Then expenditure on intermediate goods should not be taken. All expenditures on second-hand goods should be excluded, not taken into account. Expenditure on financial assets like shares and bonds is not to be taken into account, because this expenditure on financial assets like shares and bonds, it reflects only transfer of ownership. It reflects only transfer of ownership. Government expenditure on transfer payments is not included, as these payments are made without any factor service, unilateral transfer payments. That is why. Now, we come to some other precautions and difficulties, like all transfer incomes like pension, scholarship, or any unemployment allowance, etc., should not be taken into account, because these incomes are received without any product rendering or producing any services. Now, illegal incomes by the smugglers or robbers or drug traders or gamblers or thieves should not be included, because these are illegal. Interest on national debt is excluded, not included in national income, because this is treated as transfer income. Because here we assume that the government borrowings are used for consumption purpose. That is why here this interest on national debt which the people get when the government borrows money, those are to be treated as transfer incomes. Incomes received from the sale of second-hand goods, shares, bonds, etc. are excluded because they don't contribute to the current production of the goods and services. Okay, some other problems or difficulties or precautions. Sale and purchase of existing commodities and second-hand goods, I already told you. Now, services of housewives like cooking and looking after the children or doing any household activities by the housewives are not to be included in the national income estimation. Imputed rent of the self-occupied or owner-occupied houses should be considered. Own account production of fixed assets such as residential buildings or machinery or factory buildings by the entrepreneurs should be included. So these are the precautions which you need to remember. This is a gist which I have said. And if you remember these, then if the question comes in a twisted form also, if you remember these, the basic things here, then the question which comes is state with reasons whether the following are to be considered or not to be considered, are to be treated or not to be treated, are to be included or not to be included in the calculation of national income? This is a very probable question. Can be given, though it came in the last year, but this kind of question is also probable this year. Then I think if you remember these, then it can be easy for you. Okay, another precaution is some people may get some windfall profits, unexpectedly getting some money, but those profits, those gains are not against any production of goods and services, like winning prize in a lottery. That is windfall gain, windfall profits, and windfall gains are not to be considered because no production of goods and services against this. So this is also not to be considered in the calculation of national income. These are, I have made a summary, though I tried to give details also in national income chapters, the 3 chapters. I think it will benefit you. It will be useful for you if you remember these advices and these things which I have said. Thank you.